Well, banks are taking center stage today after Goldman Sachs' SEC settlement, along with mixed earnings results from Bank of America as well as Citigroup. My next guest has a buy on all of these three banks. He's Charles Peabody with Portales Partners. Charles, thanks so much for being with us. And judging from their stock price reaction today, Goldman's the only one higher.
Well, I think that's obviously related to the one-time issue of settlement.
Right.
But I think, the results in the banks, JPMorgan, Citi, and B of A, are telling the central story of an improvement in credit quality, particularly on the corporate side, but on the consumer side. There were mixed results. I thought JPMorgan's quarter was a very solid quarter, and B of A's was a very weak quarter, and Citi continues to follow the script that we've played out for it, that Citicorp, the good bank, continues to be profitable, while Citi Holdings, the liquidating bank, continues to liquidate assets close to par. So book value has integrity there.
But there's a lot of questions, Charles, don't you think, about the earnings momentum for these banks? Because some of the money being put into the bottom line is coming from the releasing of these reserves that cover the loan losses.
But that's true at every point early in the cycle. The quality of earnings is always a debate because you get lower provisions as you envision a peak in charge-offs with a lag, and non-performers are starting to slow or even decline. So I disagree with the market's assessment that these are poor quality earnings. This is what happens at every early part of the cycle in a recovery.
Okay, then what about for the second half? How does this set up the stage for the second half for these banks?
Well, I think you have a bridge developing here where lower credit costs are going to offset weak revenues. But I do think that the revenue picture comes back by the fourth quarter, early 2011.
And who's going to emerge out of this revenue picture first?
Well, I think JPMorgan has shown that their fortress-type balance sheet and their ability to invest in businesses for the future is going to be the leader. But I think, Citigroup is doing a good job of managing the bad assets while continuing to build profitability in the good bank. Right.
Charles, okay, well, despite all that, and let's just take away for a moment, all this debate about, double dip or not, or what is headed, where the housing market is headed. It seems pretty certain, right, after listening to Bernanke earlier this week, that it looks like the Fed is going to stay pretty pat on interest rates. They're going to keep with an easy monetary policy, right? Bernanke also noted that unemployment full employment is likely not going to take place, let's say, for another 5 or 7 years. Given that condition, right, how do the banks grow their way out then?
Well, let's be clear. I mean, we are creating jobs. It may not be the level of jobs we're creating, so that's a positive.
We're not creating at the pace, though, that we'd see full employment in a couple of years.
You're talking about growth in the economy as opposed to a double dip. And in terms of the housing market, the banks, I think, could withstand another, 3 to 5% drop in housing prices and still be well reserved. So I don't feel like, from the bank's point of view, that mortgage losses are a big threat. If anything, if we get stability or a small decline, banks are well reserved for that, and they can absorb that within the context of their existing reserves. What we're not talking about is significantly higher home prices, but stability.
Nobody dares talk about that yet.
Well, I think it's unrealistic to talk about significantly higher home prices. I think you can have stability, and in that context, the banks can continue to bring down their reserves. You have to put in perspective, these loan loss reserves at these major banks are close to 5% of loans. The historical norm is less than 2%, so there's significant room to bring reserves down in future quarters, right through the middle of 2011.
Right, and significant room to take that capital and put it to work.
Absolutely, and you're starting to see that at JPMorgan, where they took baby steps by buying back some stock, number one.
Right.
But I think you'll see more aggressive steps to employ that capital by year end, either through dividend increases or accretive purchase acquisitions.
Charles, just a last thought on Goldman Sachs. This settlement, does this give you more clarity here?
Well, I think it does in terms of their ability to continue to do business without headline disruptions. I think governments around the world are still going to be somewhat leery to do business with Goldman, but I think the private sector will feel much more comfortable. And I actually think that's what you're going to see on Tuesday when they report earnings, is that their core business has remained intact, and their ability to produce a mid-teen ROE is still, capable.
Okay. All right, Charles, thank you so much. I really appreciate the conversation. Charles Peabody of Portales Partners talking about the banks.